how quickly silver turned and finished up sharply. And now we're trading in the 80s, and we still have people disappointed because it should be at 200 or 300. No, the way gold and silver and copper are trading stands for very much higher prices down the road. We've seen the lows in gold, which is around 4,400. We've seen the lows in silver in the high 60s. But the longer we move sideways and work our way up, or what I like to call 2 steps up, 1 step back, the actual better would be to reach the numbers that some people still think that they can get to, with 10 or 20,000 on gold and 200 or 300 on silver. In silver, we just see a continuous increase in the industrial fundamental uses of it, and also copper. There's just no way you could hope for the things that the bulls speak about and not have copper play a bigger role in it.
What does it look like when that debt bomb goes off? What kind of world are we in that scenario?
40 trillion heading, according to the Congressional Budget Office, to 64 trillion. 30 this morning, I issued an alert, put it out on my X page, that I had thought oil peaked, gold and silver had bottomed because they were way off, and the stock market was going to turn green. And I'm not a bull on the stock market for any length of time, but for reasons that was discussed in that. And as we speak here at the end of the day, that's exactly what transpired. But I don't think it's a back to happy days are here again by any stretch of imagination. Now, a lot can happen between us speaking and whenever you may issue this report. So my view is going to be, for a minimum of a matter of weeks from now, if not months or a few years. I think what's more important, what's transpiring, believe it or not, in that was actually 2 other news stories that happened last Friday that got very little coverage relative to the oil. And what this is going to demonstrate to perhaps the thing that kept the stock market mostly up during 2025. They wheeled out last Friday spokespersons from BlackRock and all, onto the major financial networks to tell you everything's all right. And I learned from 42 years, when they're doing that, it's not all right. Because when it's all right, you don't have to worry about things. But when you got to go out and try to hold hands, that's another situation. So to answer your question, the Iran war, how it ends up here, other than a total victory and a total change there, is not a net positive. I think also what we're going to get out of this is we need it. And I've said this over and over since getting out at the almost top of the gold.
When the biggest asset managers suddenly flood TV telling investors everything is fine, seasoned market watchers usually start asking the opposite question. As Peter Grandich points out here, the real signal often appears when institutions feel the need to reassure the public rather than let markets speak for themselves. Markets rarely require public relations campaigns during healthy expansions. And history shows these media blitzes often appear near stress points in liquidity or geopolitical risk. The quiet factor here is that conflict, oil volatility, and market stability rarely coexist for long. Next, Peter Grandich discusses why gold's recent move may be less about hype and more about a deeper macro reset.
We need it after the parabolic decline to build the base again, and ideally for gold just above 5,000. And that's exactly what's happening. Darryl, you have to understand, we were talking earlier before we started. 5,000 was just a pipe dream for most of us 10 or 20 years ago. Mm-hmm. Now 10,000 is 20,000. So building a base here after the tremendous rally that we had the previous 18 to 24 months is very healthy. And I have to tell you, I was a little more impressed today on how quickly silver turned and finished up sharply. And now we're trading in the 80s, and we still have people disappointed because it should be at 200 or 300. No, the way gold and silver and copper are trading stands for very much higher prices down the road. But down the road, not tomorrow, not next week, or maybe not even next month.
And so what role does the precious metals play into this equation for those that are stackers, investors, things of that nature?
Well, I think for the near term, which for me is 1 to 3 years. And, when I was a money manager, we never gave a forecast without a 3 to 5 year outlook. You talk to people now about 3 to 5 years, they laugh at you. 3 to 5 months, maybe, Mr. Grandich, but not 3 to 5 years.
The most dangerous phase of any bull market is when investors expect instant gains instead of consolidation. As Peter Grandich points out here, markets often need long base building periods after powerful 18 to 24-month rallies, before the next sustainable move higher begins. Historically, commodities like gold and silver spend far more time consolidating than trending, even during major cycles like 2001 to 2011. What investors often ignore is that slow sideways movement is exactly how institutional money quietly accumulates positions. Next, Peter Grandich talks about why precious metals still hold a strategic role, despite investor impatience in today's short-term trading culture.
But I think if you're investing for the long term, the arguments still that exist to own physical metals have not changed. We're seeing again how out of whack countries are with their fiat currencies through debt, through mismanagement, etc. The inevitable implosion, whether it's serious deflation or huge out of control inflation, most paper is not going to be worth, as they say, the print and the paper that it's printed on. So I think they will always be viewed by people as an alternative to fiat currencies. What I do think, and why I've been more attuned, more bullish than over the years when I used to get yelled at for not being as bullish on silver as gold, is that in silver we just see a continuous increase in the industrial fundamental uses of it, and also copper. There's just no way you could hope for the things that the bulls speak about and not have copper play a bigger role in it. So I think it's the one area I still think, while not cheap anymore, is still playable across the board when you look at that versus, say, the general U.S. equity market or technology and things of nature. They still, to me, have 20 to 30 to 40% potential to go lower over the next few years.
Behind every precious metals rally sits the same uncomfortable question about fiat currency stability. As Peter Grandich points out here, the long-term case for physical metals hasn't changed because global debt levels and currency management problems continue to grow faster than economic output. Investors often overlook how industrial demand for silver and copper is quietly rising alongside electrification, solar expansion, and data infrastructure growth. Meanwhile, many US equities still trade at historically elevated valuation multiples compared with commodities. Next, Peter Grandich discusses why metals may still outperform traditional equity sectors if the next market cycle turns defensive.
The last two gold bull markets, we had a correction along the way. So, for example, I think it was in the 70s, we had about a two-year time of correction. I think it was between 74 and 76. Then we had a one-year correction between 2008 and 2009 before we ran up and had to blow off top. So curious if a correction, a year-long correction or more, especially if the S&P or the Dow turns over and significantly starts to fall, do you see that in the cards for the metals?
So my view has been, I stepped aside before the parabolic bust happened. I came within $4 at the bottom, which was just a lucky guess, I guess. But the bottom line to me was that it was going to take many weeks, at least a few months, if not almost the balance of the year, before both gold and silver would make new all-time highs. And the longer it took, the better it was for those that still want much higher prices. So my best guess, and that's all we ever do, I don't know what anybody else tells you when you interview, but that's all we could do is make a good guess here, is that we've seen the lows in gold, which is around 4,400.
Bull markets rarely move in straight lines, even when the long-term trend remains powerful. As Peter Grandich points out here, both the 1970s gold run and the 2000 cycle included long corrections lasting 1 to 2 years before the final surge higher. Investors often forget that consolidation phases are not a weakness, but structural resets where weak hands exit and stronger capital enters. The bigger risk actually appears when metals rise too fast without correction, because momentum eventually exhausts itself. Next, Peter Grandich unravels why the recent lows in gold could mark the start of a longer accumulation phase.
We've seen the lows in silver in the high 60s, but the longer we move sideways and work our way up, or what I like to call 2 steps up, 1 step back, the actual better would be to reach the numbers that some people still think that they can get to, which 10 or 20,000 on gold and 200 or 300 on silver. How long that takes, if I hoped it was 6 months and it took a year, I learned many things we can spend another show about what not to do. But I can just tell you this, it's better to be a year too early than a day too late. And I don't think we're late yet in the metals. I still think they will be higher than lower going down the road.
The quiet discipline of investing often clashes with the market's obsession for instant results. As Peter Grandich points out here, the 2 steps up, 1 step back structure is exactly how sustainable commodity bull markets develop over time. Investors chasing quick price spikes frequently abandon positions during these slow phases, even though historical cycles show metals can take years to reach major price targets. Patience, not timing perfection, tends to determine long-term returns in assets tied to macro cycles. Next, Peter Grandich talks about why the bigger story behind metals may actually lie in the global debt system itself.
What does it look like when that debt bomb goes off? What kind of world are we in that scenario?
Well, this is where the one time I don't mind being is turning 70 on April 2nd, because I may not be here when that transpires. It's sad. So let's talk about that now. We should be serious about that. So we have 2/3 of Americans working paycheck to paycheck. We have 2/3 of Americans that don't even have $1,000 saved for emergency. And 1 out of 4 workers now is using some sort of debit just to get by daily life, gas, food, clothing, rent, etc. What are these poor souls going to be at when the government can't even provide half the services that it provides now? And the natural tendency for them is to ask the government to help them, especially those that are aging and find it much more difficult to be working at an older age because you can't live this fantasy of retirement and, sitting down in Florida and playing golf, fishing, whatever the case may be. And so it's a much troubled outlook. And it doesn't have to actually be at that point, because as we get closer here and as people realize that, there's going to be more of a movement towards socialism. And that's why the hard left right now of the Democratic Party gets an ear, because basically they're doing what's been done for centuries.
Most debt discussions stay abstract until you look at how fragile the average household already is. As Peter Grandich points out here, nearly 2/3 of Americans live paycheck to paycheck, and many lack even a $1,000 emergency cushion, meaning a major fiscal shock would ripple through everyday life quickly. The hidden risk investors overlook is that economic stress rarely stays confined to markets. It spills into politics, policy shifts, and social pressure. When fiscal strain rises, governments historically expand intervention. Next, Peter Grandich discusses the growing wealth imbalance shaping political and economic decisions.
Point to the elite, say that you're suffering because how those people are living, and you got to take something from them. And here's the bottom line. The 10% wealthiest Americans own 86% of all the assets. The remaining 14 is the next 40%, and half don't have it. About a month ago, the top 1% wealthiest Americans had more wealth than the entire middle class. And in a consumer-driven economy, which we are, 2/3 of our GDP is consumer-driven, the bulk of that driving came from people not in that 1%. Now, we've been sustained somewhat because they've been living a life of luxury and going us, but more and more people are struggling and not spending the money that expectations will be. And as we get into latter part of this year and we have an election, and if there's a change, at least in the House and or the Senate, everything is going to stymie. Nothing's going to move forward. For 2 years, there'll be, impeaching Trump 22 times over, et cetera, et cetera.
Yeah.
It's not a pretty picture, and we don't have to wait for 10 years from now. It's just going to get worse as the months and few years pass in front of us.
I'm curious in your outlook on the increase in the military budget.
When wealth concentration reaches extremes, the market story quietly becomes a political story. As Peter Grandich points out here, the top 10% controlling roughly 86% of assets creates a structural imbalance in a consumer economy where spending drives about 2/3 of GDP. If the majority of households face rising costs while asset wealth stays concentrated, consumption eventually slows and political pressure rises. Election cycles often amplify this tension as policy debates shift toward redistribution, taxation, or spending programs. Next, Peter Grandich talks about defense spending and how massive government budgets intersect with America's growing debt problem.
I think Trump mentioned $500 billion extra last year, and then I think he came out and said $1.5 trillion, which I think is the same because it's about $1 trillion now plus $500 billion. So it seems like defense spending is going to kick up significantly. So what do you see there? Do you see there's opportunities there? How are you processing that?
Well, we're going to hit very soon 40 trillion in national debt. And just a couple of weeks ago, the Congressional Budget Office now is forecasting it's hard for me to say this, Darryl. I was telling you when we would talk about how long ago I was 38, I was still a stockbroker back then. We didn't know what a trillion was. There wasn't a trillion anything. Now we're going to have 40 trillion heading, according to the Congressional Budget Office, to 64 trillion. And one of the issues that I think is important, that, if I may interject here, we had the bond actually rise in rates, which years ago when a conflict like this took, the bond market had a strong rally. And that reason is, and one of the things that I keep talking about is, I don't suspect we'll ever be able to get much below 4% on the 10-year, whether we have a weak economy or not.
The quiet shift in bond markets may matter more than the headlines about defense budgets. As Peter Grandich points out here, rising US debt approaching $40 trillion is colliding with a world where bond yields may struggle to fall below roughly 4% again. Historically, during geopolitical conflict, investors rushed into bonds, pushing yields down. Yet recent market behavior shows the opposite dynamic emerging. That signals growing concerns about long-term fiscal stability rather than short-term risk events. Next, Peter Grandich unravels why global investors may soon question America's ability to service its debt.
Is because more and more people around the world are growing more and more concerned about this country's ability, forget about paying the principal of it back, now paying the interest. And this is the one question, if you said, Pete, if you had one wish right now, what would it be other than wishing you a happy birthday? I'd like to go on the national networks and ask all these talking heads to come on. If the Congressional Budget Office is correct, but let's go with their original talk, just 50 trillion, they said 2 years ago, by 2035. At 50 trillion and a 5% interest, we'll have a 2.5 yearly trillion interest expense. The best this government's ever done, Darryl, is a little over 5 trillion in income. We're going to be talking about almost half of our income going towards paying an interest expense. There is no way the government we're used to right now and the services and all they provide, including Social Security, Medicare, what have you, will be able to function in that regard. And so whether you talk whether it's going to defense or whatever it is, we're in an unsustainable path. And people can say, well, I've been hearing that for years. You're correct. But it's accelerated to the level now that almost everybody watching this is going to be living when the time bomb goes off.
The uncomfortable math behind government debt rarely appears in daily market headlines. As Peter Grandich points out here, if US debt reaches around $50 trillion and interest averages near 5%, annual interest payments alone could approach $2.5 trillion. That number would consume a massive share of federal revenue, potentially rivaling spending on major programs like defense or healthcare. Investors often focus on stock valuations or earnings reports while ignoring the structural fiscal pressures building underneath the economy. Next, Peter Grandich discusses why global buyers of US debt may eventually demand higher compensation for rising risk.
And it's going to go off well before 2035 because people around the world are not going to keep buying our debt, certainly not at very low interest rates. They're going to want a much higher interest rate to take the higher risk that's going to come along with it. So I think, regardless of whether defense spending goes up or whatever the case may be, the complete out of control of our debt on the national level is still, despite all sorts of other issues now we're facing, still the biggest 800-pound gorilla in the room.
Okay. So what is...
Markets often assume the global appetite for US debt will remain endless, but history rarely supports permanent financial privileges. As Peter Grandich points out here, if international buyers demand higher yields to compensate for fiscal risk, borrowing costs across the entire economy could rise with them. Higher treasury yields don't just affect government budgets, they influence mortgage rates, corporate financing, and equity valuations simultaneously. That's why long-term investors watch bond markets closely during debt expansion cycles.